I want to confess something that most finance content creators won't say publicly. I don't try to predict macro, not because I think macro is unimportant. It isn't. Not because I think economic conditions don't affect businesses. They do. But because the evidence on macro prediction is overwhelmingly and consistently humbling. Almost no one gets it right consistently, and the people who get it right once rarely get it right twice. Professional economists with dedicated research teams, proprietary data feeds, and decades of experience cannot reliably predict GDP growth, interest rate movements, or currency direction 6 months out. The track record is public and not and it is not flattering. So the idea that reading the same public information, am going to form reliable macro predictions and make better investment decisions because of them is not a belief I can defend analytically. But here is where I want to push back on the opposite extreme because ignoring macro is entirely also wrong. Most investors I observe make one or two mistakes. The first, the macro obsessive, they spend hours every week reading economic reports, following central bank commentary, tracking inflation data, forming views on where the rupee is going and what Fed will do next. Make investment decisions based on those views. The problem with that is those views are built on predictions and are more likely to be wrong than right. The macro obsessive is substituting someone else's unreliable forecast for their own analytical work on business fundamentals. The result is a portfolio driven by macro bets that nobody can reliably win. The second, the macro ignorer, focuses entirely on business quality and valuation, believes that great businesses held at reasonable prices will deliver regardless of macro environment. This is closer to correct, but it misses something that every long term investor has felt in practice. The macro environment determines how long you can wait. You have to wait. Um, a turnaround thesis that plays out in 18 months in normal markets might take 3 years in a hot one that is going to be cold. Um, Basically, if you buy at the top, it might take longer for you to make money. Ignoring that reality leads to poorly calibrated patience and poorly sized positions. The approach I use is different from both. I use macro as a thermometer, not a crystal ball. A thermometer tells you the current temperature. It does not tell you what the temperature will be next week. It gives you accurate information about where things stand right now, which is genuinely useful. A crystal ball claims to tell you what the temperature will be in the future, which is genuinely unreliable. In this video, I want to show you exactly how I read the thermometer, what three things I actually monitor, what I deliberately ignore, and how current temperature reading is affecting where I'm deploying capital right now. Let's start with what the thermometer with what the temperature actually means. Let me define precisely what I mean by the market temperature, because vague concepts produce vague decisions, and the entire value of this framework depends on it being specific. Market temperature is the aggregate level of risk appetite, valuation, liquidity, and investor sentiment across the markets at any given moment. It is not a prediction, it is a description of where things are currently standing. Let me break that definition into three components because each one tells you something slightly different. Risk appetites. How willing are investors to take on uncertainty in exchange of potential return? In a high risk appetite environment, investors bid assets up aggressively, accept lower margins of safety, and chase performance. In a low risk appetite environment, investors are cautious, demand larger discounts to intrinsic value, and are willing to hold cash rather than deploy it into uncertain situations. Risk appetite is visible in behavior, how quickly good news is priced in and how harshly bad news is punished, whether investors are buying or selling into uncertainty. Valuation, where prices sit relative to their own history across different categories of market the market. Um, Not whether the market is expensive or cheap in absolute terms. That is a judgment that requires a view in the future. But whether the current PE, EV to EBITDA, and price to sales ratio of the entire market um, of the entire market are below their own historical averages, and how close are they to their historical peaks or troughs. That comparison requires no prediction. It is a it is a factual statement about where current prices sit relative to where they have historically been. Liquidity, how freely capital is moving through the market. In a highly liquid market, money flows quickly into investment opportunities. Re-ratings happen faster, and gaps between price and value closes more quickly. In a low liquidity environment, capital moves slowly, re-ratings take longer, and theses that are analytically correct can underperform under extended periods of simply because the to liquidity to drive recognition is not present. But a good thing with a low liquidity market is you can buy extremely discounted stocks at really discounted valuations because the re-rating takes longer. And when when the liquidity is at its bottom, which we can check through multiple indicators, and we can check if there are historical bottoms, which can help us analyze if the is at is at its bottom too. And if we buy then our margin of safety increases drastically. Now, and uh, the most important point about the market temperature, it is almost never uniform across all the markets simultaneously and even the sectors simultaneously. Like, for example, right now the thermometer does not show one reading for the whole market. It shows different reading for different categories. So for ID sector, the reading is cold, valuation below historical averages on multiple methodologies. Risk appetite in the sector is low because AI disruption fears. Liquidity is moving away from the sector as institutional investors reduce tech exposure. And the FMCG sector too. Cold, it's basically cold. Valuations compressed relative to historical levels. Risk appetite low because of rural demand, uncertainty, and input cost concerns, beginning to show early signs and warnings of monsoon data as the monsoon data improves. Um, small caps are normal to warm. Valuations have recovered significantly from their lows of 12 to May 18, to like six months ago, around April. Um, Not 12 months. Risk appetite in small cap spaces has increased as the broader market has recovered. Liquidity flowing back into the category and the broad Indian market. It's normal, neither deeply discounted um, nor significantly overvalued relative to historic history. It's fairly to a little bit on a scale to on a scale of 1 to 100. It's around 46, 44, around that. So it's in a fairly priced environment. Now we can do this in the we can do this for the US markets too. Like for example, the US markets are anywhere from 71, around a 71, and 100 is really hot and one is cold. So US markets are relatively hotter to the Indian markets, which is not a good sign. um, this differentiated temperature reading is actually more useful than a single market wide reading because it tells you precisely where within the market the asymmetry is most pronounced. Not markets are cheap, but everything, buy everything. Not markets are expensive, sell everything. Something more precise and more actionable. These specific sectors are cold, while these others are warm. The fresh capital should be deployed where the temperature is cold, and the fundamental thesis supports it. Now, why does temperature matter even for the long term investor who believes that business quality determines uh, long run returns? Longer run returns. Two reasons, and both of them affect decisions that even the most patient investor has to make. First, temperature determines how long you need to be patient. The same turnaround thesis, the same business, same path, or same recovery path, same fundamental conclusions play out faster or give you more a risk to reward ratio in a cold market where there's less liquidity. So so there's more discount for good companies, and the risk appetite is low, so everyone is out of the market, rather than a cold market where the market has already probably priced the turnaround, and that is the time you should sell the stock. As the market has high liquidity and their risk appetite is high, um, you might you might need to calibrate a 36 you might need to calibrate a 36-month long thesis, um, to maybe to a 6 year long thesis if you are entering in a hot market. That is calibration or pessimism. It is a realistic it is realistic expectation management that allows you to maintain conviction through the extended wait without making a premature exit. Second, temperature determines where fresh capital finds the best asymmetry. In a warm market, most categories are expensively priced. The opportunities that meet the framework standard are fewer. In a cold market, more categories are below historical valuations simultaneously. More opportunities meet the standard. Fresh capital should be more aggressively deployed in cold environments and more conservatively held in warm ones. This is not market timing in a conventional sense. Buying when markets are going up and selling when they are going down. It is it is valuation discipline applied at category level, deploying capital where the temperature creates asymmetry, and holding cash where it doesn't. This is the exact opposite of what retailers do. Again, they buy when the markets are going up and sell when the markets are going down. The thermometer tells you where to look and how long to wait. It does not tell you what to buy or when the temperature will change. For what to buy, that is the seven question checklist. For when the temperature will change, that is a crystal ball. And I do not own a crystal ball. Let me be specific about what I actually track. Because a framework without specific inputs is just a philosophy that never produces a decision. I track over 84 things across 14 different categories, weighted on their reliability. So if they're really reliable to predict on predicting market temperature, I'll um, I'll give them high weightage, and if they're less reliable, then I'll give them low weightage. And after doing this analysis for this month, I got a I got a rating of 71 for the US market. I'm not gonna show you the exact things and how I exactly track it because that's proprietary for my own research, and I would like to keep it private. That I would like to keep it private. So for those reasons, I will not share them, but this is how I track it, and this is the end result that it gave me. So for this month, the what do you say, the reading is 71 with the current market stage at late bull. So it's like it's near euphoria, but it hasn't gone to euphoria yet. there's approximately there's approximately 68% chance of it being in late bull, and then the other rest 30, no, I think there was approximately 62% chance of it being in late bull, and 35% in euphoria, I think, and 5% and 3% in mid bull, whatever is left in mid bull. So uh, my the recommended portfolio stance here is in this month is defensive. The aggressive score is the 29, so we shouldn't be that aggressive. A high aggressiveness score is means that we should put most of our money in the market, and a low aggressive score means we should put less money in the market. Risk level is super high right now. It's high right now. That means you're taking more risk for the same amount of reward. So let's say if the reward was $100 and the risk was $80, as a in high, let's say the reward was $100 and the risk was $50, then right now you're taking $80 as a risk compared to a low risk environment where you're only taking $30 as a risk. So that's what the risk level measures. Total market regime is transition. So the market is transitioning from a hot market to a cold market. A cold market is where you get most of the bargains. So right now it's gonna go in a transition for that. Bull probability is 61%, so it's in a bull market. Bear probability is 28, so it's not in a bear market, or it has. Sorry, the bull probability is 61. That means it may go on for a little longer as it gets to euphoria, and there's a 28% bear probability. That means it may crash right now. Um, and then the temperature percentile. So this is the highest it has been in 24 months, and that 24 months is my tracking history basically. How long have I tracked it for? Again, I measure these 14 categories: investor psyche, how are investors feeling, like are the investors super, what do you say, super bullish or super bearish. Risk appetite, was the risk appetite, is there a bloodbath in the market and like people don't want to put in money, or people are flooding in the market. Valuation, If the valuation is super high, then the market is hot, and if it's low, then the market is usually cold. Again, green is cool and red is hot. Yellow means the valuation is normal right now. Credit, that means is there a lot of credit? Is there like a lot of debt? Like, is there a lot of activity in the debt market, or is there low activity in there in the debt market? Liquidity, is there a lot of liquidity? Is the what do you say, the re-rating, is the re-rating happening really quickly, or is it taking a lot of time? And is there money flowing in the market, or is there no money flowing in? And then there's economy. Economy is basically like, is the economic condition good or not? And then corporate fundamentals, this checks if the corporate fundamentals are good. And usually when they're like really good, when they're going up a lot and everything is going amazing, companies are posting 20% growth year on year. It usually suggests a hot market. And when everything is not going great, it usually suggests a cold market, and that's where we should buy it, as it's gonna turn hot as everything recovers. Technicals, these are chart patterns and all that: 52-week high, 52-week low. So we check if the chart patterns are showing the market is hot or the market is cold. This again shows the market is relatively cold to its previous highs, to its previous what do you say, its previous highs, as in when it was hot. It's relatively cold in compared to that. Speculation is whether retailers or anyone, even institutions, are putting money in a lot of high risk assets, and whether there's a lot of speculation going on, like people asking for, um, basically people asking for less returns, for more amount of risk, and people just putting in money wherever they want. Market leadership is only a handful of companies taking the S&P 500 or the market up, or is the whole sector, is the whole, what do you say, or if the whole universe, the whole 500 stocks are taking it up. That's what market leadership measures. IPO environment, is there a lot of IPOs going on? Every new day there's the IPO, every or if there is relatively low IPOs. For example, in 2009 or 2008, when there were like 82 IPOs in the whole US market, I think something like that, some number like that. Private markets, if the private equity is putting in money, they're buying stocks out or whatever like that. Is that leverage, is everyone taking a lot of leverage? Are they doing margin trading? Is total margin to like total GDP ratio up or a low? Margin to GDP ratio, basically. Yeah, that thing too. And volatility, is there a lot of volatility in the market, or there's relatively low volatility in the market? High volatility means the market is colder, and a low volatility environment is hotter. And then here are risks, and then here are charts of the thing. So in total, um, after measuring all of them based on their weightage, I come up with a number from 1 to 100. One meaning cool, and 100 meaning hot. Right now it's at 71%. So that means it's pretty hot. And I do this every month. Of course, I'm not gonna share this data with anyone because this is proprietary, and I'm not gonna share how I do this. This is all public. I only use public information for that again. But in the future, if I open my when I open my own shop, I'm gonna I'm gonna probably have some more data for it. Of course, legal data. None of it will be illegal. of course. So yeah, again, this was just a quick snapshot of what my what do you say market sentiment thing looks like. Um, Let me tell you what I don't track and why. Because I think the exclusion list is more useful than the inclusion list for most investors. Most people already know they should be tracking valuations, deal flows, and etc. Almost nobody has explicitly decided what to stop tracking. And the inability to stop tracking noise is what turns macro monitoring from a useful temperature reading exercise into an anxiety producing distraction that degrades decision quality. Four things deliberately excluded, not because they are unimportant to the economy, some of them are genuinely important, but because they fail to produce useful temperature information on a timeline that improves investment decisions. GDP is one of the most important measures of economic activity that exists. I'm not disputing that. What I'm disputing is the usefulness of GDP forecasts specifically. The actual reported GDP number, when it arrives as official data, updates my temperature reading. If US's GDP growth comes significantly um, below the um, historical highs or lows, then we update that, um, and that is a cold temperature signal that affects the timeline of every thesis I hold in domestic consumption facing businesses. That number, when it arrives, is useful. The forecast of where GDP will be next quarter, produced by economists who cannot reliably predict it, distributed by financial media as if it were fact, and consumed by investors who make decisions based on it, is not useful. It is just noise wearing a costume of analysis. The evidence on GDP forecast accuracy is public and consistent. Professional forecasters, with dedicated teams, proprietary models, and access to leading indicators that retail investors cannot access, miss GDP turning points regularly. They are most wrong precisely when being right is the most important. At inflection points where the economy is transitioning from growth to contraction or vice versa. I read GDP data when it arrives. I do not read GDP forecasts. The distinction saves approximately 2 to 3 hours per month of analytical time that is better spent on business level research, which we can actually get better at, and we can actually get an accurate forecast on it. 2. Currency predictions. The rupee dollar exchange rate affects every business I own that has significant foreign currency revenue or foreign currency costs. TCS generates the majority of its revenue in dollars. That dollar revenue translates into rupee at whatever the prevailing exchange rate is when it is reported. Currency matters. Currency matters to the business. What I do, understand the current to understand the currency exposure of each business I hold, and build it into the thesis conservatively. Um, if TCS generates $30 billion in annual revenue and the rupee depreciates 5% against the dollar over my holding period, that translates into a specific rupee revenue benefit. I can calculate. If the rupee appreciates by 5%, the opposite. I model both scenarios and assess the position on the variable in the adverse scenario. What I do not do. attempt to predict which direction the rupee will move and to time positions around that prediction. Currency markets are among the most efficiently priced markets in the world, incorporating information from central bank action, trade flows, capital flows, interest rate differentials, and geopolitical developments simultaneously. The idea that I can reliably view that I can form a reliable view on rupee direction that the market has not already priced is not analytically defensible. And to understand the exposure, model the scenarios. I do not predict the direction. That is the complete currency framework. 3. Central bank forward guidance. The RBI policy rate at any given moment is useful temperature information. It tells me the current cost of credit in the economy, which I use in the credit condition monitoring I described in the previous section. When the rate changes, I note the change and update my temperature reading accordingly. What I do not track. The interpretation of governor's statement, the reading of Monetary Policy Committee minutes from for signals about future rate decisions, or the analysis of forward guidance language for clues about the next policy meeting. Here's why central bank forward guidance is specifically designed to be interpreted. It is crafted language, reviewed by committee, calibrated to avoid market disruption. The financial media and analyst community apply enormous effort to interpret that language and consistently disagree with each other about what it means. The rate that actually arrives at the next policy meeting frequently surprises the consensus view, despite all of the interpretive efforts. More importantly, the rate that the RBI sets at the next meeting will be reflected in my credit condition monitoring the quarter after it is set. I will see the impact in banking sector NIM data and co- in the company level credit cost disclosures. The actual impact measured in real data is more useful than predicted impact measured in committee language interpretation. I wait for the data, I do not wait for interpretation signals. 4. Daily news flow. This is the most important exclusion on the list, and the one that most investors will find most challenging to implement, because financial news is designed to be compelling, urgent, and psychologically difficult to ignore. Daily financial news serves one primary commercial purpose: generating engagement headlines that create urgency, that suggests the market is about to move significantly, that frame normal market fluctuations as crises or opportunities. These headlines drive clicks, views, and time spent on platforms. They are optimized for engagement, not analytical usefulness. A headline that says Nifty falls 300 points on global cues tells me nothing about whether any business I own is more or less likely to achieve its thesis. A headline that says IT sector under pressure amid AI fears tells me nothing I didn't already know from a monthly valuation check. A headline that says RBI signals caution on inflation tells me nothing more useful than the actual rate decision will, when it arrives. Daily news creates a psychological pressure to act, to respond to headlines, to make a decision in response to information that did not does not actually change the temperature reading. or the thesis in assessment that pressures the feeling that something is happening to you, and you should do something about it. That is the enemy of process dependent investor. I check financial news approximately once a week, not daily, not every hour, once a week. Enough to be aware of significant corporate events affecting businesses I hold, not enough to influence my by the daily noise of the market, the markets that generate regardless of whether anything important is actually happening. Four exclusions: GDP forecast, currency prediction, central bank forward guidance, daily news flow. I want to acknowledge something directly. Implementing these exclusions is harder than implementing the 84 inclusions I described in the previous section. Adding 84 new data checks to a monthly routine is difficult, but it's not as difficult as this. Stopping the consumption of information you have been trained to consume is generally more difficult than that. The financial industry profits from your attention to macro noise. Every newsletter, every news platform, every financial media outlet that covers macro is competing for the analytical bandwidth that you have a finite supply of. Taking that bandwidth back, deliberately deciding what not to track, is an act of portfolio discipline, as important as any investment decision. The investor who tracks fewer things more carefully makes better decisions than the investor who tracks more things less carefully. Not because the information is bad, because most macro information is noise, and noise processed through human psychology produces worse decisions than the absence of the noise would. Even if you want to track more things, then track those things that are not forecasts or predictions. Track things that have happened or that are happening right now, and that has happened. So, like, you have a solid data, not a future forecast that could be wrong, and you have a solid data to fall back onto. Everything I've described so far, what temperature means, what I monitor, what I ignore, is only useful if it actually changes decisions. Let me show you the three specific decisions the market temperature affects in my portfolio, and precisely how the current market temperature reading is influencing each one right now. Decision 1: how aggressively I deploy fresh capital. In a cold market where multiple categories are below historical valuations simultaneously, more opportunities meet the asymmetry standard. The framework produces more green lights. Fresh capital should be deployed more aggressively because the number of positions that genuinely justify entry is higher than the normal environment. In a hot market where most categories are above or at historical valuations, fewer opportunities meet the standard. The framework produces fewer green lights. Fresh capital should be held more conservatively, not because the market cannot go higher. They can, and they absolutely will, if the greed continues like this. But because the asymmetry is elevated, valuation is less compelling, and the downside in the event of the thesis error is larger uh, when starting from a high multiple. In the current mixed market, selective and disciplined IT and FMCG sectors are cold. Fresh capital directed there where specific setups qualify within the swing trading framework. Small caps are warm. Fresh capitals cannot be directed there regardless of how compelling the individual stories sound, because the category level temperature does not support adding new positions at the current valuation. Cash held where no qual no qualifying setup exists in a cold sector. You can also check this. I have a good way to check this is by looking at my turnaround blogs as by looking at my turnaround screener for my blogs. Because in a hot market, it usually gets really hard for me to find good turnarounds for the blog calls. In the blog, I try to only write about the turnarounds who are the cream of the crop. So, yeah. So as you can see, recently I've uploaded a blog on Sterlite Technologies. Now that's not a turnaround, that's a sell thesis. Whenever I upload a sell thesis blog, it usually signals that I'm running out of good turnaround blogs, and I have to look at short thesis or sell theses to actually make a blog every week. So that's a really good indicator if the market is cold or hot. This is the live portfolio decision I described in the large cap rotation video. The temperature reading is directly producing the capital deployment decision, not a prediction about where the market is are going, but the current observation about where asymmetry exists right now. Decision 2. Now, where within the range I size each position. The position sizing framework 2 to 6% based range conviction and asymmetry as two determining variables is fixed. What temperature affects is the asymmetry variable within the framework. The same level of fundamental conviction produces different asymmetry at different market temperatures because asymmetry is a ratio of potential upside to potential downside from the current uh, from the current entry point, and the current entry point is directly affected by the temperature. In a cold market, entry prices are depressed relative to fair valuation. The upside to fair value is larger. The downside to balance sheet floor is smaller. Because the starting price is already close to the floor, asymmetry is more produced. The same conviction level justifies a position towards the upper end of the range. In a hot market, um, entry prices are elevated relatively to a fair value. The upside for to fair value is smaller. The downside to fair value is larger because the starting price is above it. Asymmetry is compressed. The same conviction level justifies a position toward the lower end of the range, or no position at all if the asymmetry falls below the minimum standard. The current mixed market position in the cold sector is sized towards the mid to upper end of the range because the driven depression in those sectors is improving asymmetry. Existing small cap turnaround positions entered when those categories were cold held at their original sizing because the thesis and the target are intact, not because the current temperature would justify initiating them at current prices. This distinction, size based on the temperature at the time of entry, is not the current temperature is important. I do not reduce the position because the sector has warmed since I entered. I entered at the right temperature. The thesis determines whether or not. I hold not the current sector temperature. Decision 3. How long I expect. This is the decision where the temperature has most underappreciated impact, and the one where most investors are frequently surprised by their own emotional reaction to a holding period that exceeds their own expectations. In a cold market, the same turnaround thesis takes longer to be recognized. Liquidity is concentrated, risk appetite is low, are not actively looking for opportunities that the framework identifies. The period between the thesis establishment and market recognition can be 2 or 3 times longer than the normal market. Building that into emotional expectations before entering the position is what allows conviction to be maintained enough through what that extended wait. But it's not like the market won't reward you for the extra weight. The market will reward you handsomely and sometimes even more than you expect for the extra weight because the prices are so low that even if you buy it and the prices don't go anywhere for like 2 or 3 years, within 1 year, within 1 or 2 years, when the market is going up again, your prices will shoot up like crazy, and you will make amazing money if you don't sell and you are patient for because of that. In a hot market, thesis recognitions happen faster, liquidity is abundant, risk appetite is high, investors are actively seeking returns and are more willing to bid up businesses in recovery. The same thesis that would take 36 months in a cold market plays out in 18 months in a hot one. The creating on the current mixed market, the patient calibration is differentiated by sector. Cold sector positions like IT and FMCG swing trades expect shorter holding periods because the catalyst for re-rating is a specific narrative shift that can happen quickly once evidence accumulates. Existing turnaround positions in small caps and mid caps entered in a colder environment are calibrated for the longer holding period that the original entry temperature implied. Those calibrations cannot be revisited because the small cap category has warmed. The original entry established expectations, and the thesis determines whether those expectations are revisited or not. Three decisions, one temperature reading, specific differentiated outputs for each. I want to make I want to make one observation about how these three decisions interact the interaction is important as each decision individually. Capital deployment, aggression, position sizing, and patience calibration all point in the same direction. When temperature is correctly read, a cold market produces more aggressive deployment, larger positions within the framework range, and extended patience calibration. A hot market produces conservative deployment, smaller positions, and shorter patience calibrations. They reinforce each other. When an investor's decision at when an investor's decisions point in a different direction, deploying aggressively but sizing conservatively, or entering at hot valuations but calibrating for a short wait, is usually it usually signals that one of the three inputs is being determined by something other than temperature, often by emotion. The excitement of a new position override, the sizing discipline, the impatience of with a cold market override with the patience of calibration. The framework is internally consistent precisely because of all three decisions flow from the same temperature reading rather than from their separate emotional inputs. That consistency, the same thermometer reading, produced a coherent decisions, the coherent decisions across deployment, sizing, and patience is what makes temperature-based macro thinking uh, useful rather than just interesting. Let me bring everything together. The mistake most investors make with macro is binary. Either they obsess over it, spending hours forming predictions that are likely to be wrong than right, making portfolio decisions based on forecasts that professional economists with dedicated research teams cannot reliably make, or they ignore it entirely, missing the temperature informations that affect the long every thesis takes to play out and where fresh capital finds the best asymmetry. Neither extreme is correct. The framework I've described today sits between those two extremes, and I want to be precise about exactly where it sits. Three things, around 84 things I monitor monthly and quarterly, depending on their availableness across 14 different indicators, 14 different categories. They all are weighted. They all are weighted. What do you say? They all are weighted based on how reliable they are, and they are calculated, and their weightage is calculated based on the how high, how close are they to their historical highs or lows, depending on the indicator. Four things I deliberately exclude: GDP forecasts, currency predictions, central bank forward guidance, interpretation, and daily news flow. Not because they are unimportant to the economy, but because they're either generally unpredictable, already reflected in the data, or already reflected in the data I've tracked, or optimist for engagement rather than analytical usefulness. Three decisions affected by the temperature reading: capital deployment aggression, position sizing within the framework range, and patience calibration for thesis recognition timelines. All three pointing in the same direction when the framework is applied consistently. The thesis of this video in two sentences is the macro is a thermometer which tells you the current temperature of the market environment accurately and usefully, which is genuinely valuable for calibrating capital deployment, position sizing, and patience. But it cannot tell you what the temperature will be month, next month. Um, and the investor who uses a crystal ball wastes enormous analytical energy on the least profitable variable in the investment equation. The discipline is not about predicting macros. It is about reading current temperature precisely, adjusting three specific decisions accordingly, and refusing to act on predictions that nobody can reliably make, including the ones that sound most compelling at the moment. Um, and one more thing I would like to mention is if you really want to understand this whole temperature taking exercise and like analyzing macros and all that, then I would really recommend you reading The Most Important Thing and Mastering the Market Cycle by Howard Marks. Again, I'm a little biased. I've already read it, and I've read it recently. That's why it has made a big impact on me personally. But again, if you want to make yourself better in this field, then I highly recommend you read it. And that concludes this video. Please like, share, and subscribe. And remember, judge the process, the capital will follow.